The first thing most people would do if a world war started tomorrow is open their brokerage app. Not call a family member, not check on someone they care about, their brokerage app. Because that is what financial anxiety does to a person. It hijacks every rational instinct and redirects it toward a portfolio that, in the grand scheme of global conflict, does not need your attention right now. And here is where it gets genuinely interesting. Because while that person is panic selling their index funds at 6 in the morning and convincing themselves they're being proactive, someone else is doing something that looks, from the outside, completely irrational. They are buying. Not randomly, not recklessly, but in a very specific order based on what actually happens to money during every major conflict this country has ever fought. What follows is going to feel wrong for most of the time you are hearing it. The history of war and money is one of the most counterintuitive stories in all of finance, and if you do not understand it, the next crisis will cost you a significant amount of money you never had to lose. Before a single investment is discussed, something more important needs to be addressed first. There's a group of people rooting harder than anyone for you to make the wrong financial decision during a crisis. They are not foreign governments. They are not hedge funds. They are the financial media. And this is not a conspiracy. It is a straightforward business model. Every time geopolitical tension rises, viewership climbs and ad revenue climbs with it. The more frightened you are, the longer you watch. The longer you watch, the more revenue the platform generates. Your panic is quite literally their product. So when markets fall 2% on a war headline and the Chiron reads global markets in free fall, it is worth understanding what is actually happening. A 2% decline is an ordinary market day. It has been framed as free fall because free fall generates clicks. The financial media does not simply report on fear, it manufactures urgency around it. It finds the most alarming commentator available, gives them airtime, and cuts directly to a commercial for a brokerage platform that will process your panic-driven trades for a fee. The news segment, the expert, the platform, and the advertisement all profit from you doing the exact wrong thing at the exact wrong moment. Consider two investors. Mark is a reasonably intelligent person with around $40,000 in index funds, a stable income, and a habit of consuming too much financial news. When Russia invaded Ukraine in February 2022, Mark watched 3 hours of coverage, encountered the word crisis approximately 47 times, and sold his entire portfolio before 9 in the morning. Sarah had the same portfolio and received the same news alerts, but Sarah had read one specific data point before that morning arrived. The S&P 500 had recovered from every single major armed conflict since World War II within an average of 47 trading days. She turned off the television, kept her automatic contributions running, and went to work. Everything that follows is the story of what happened to their money. The gap between them is going to feel deeply frustrating, not directed at Mark, but at the system that convinced him his fear was actually clarity. Markets do not collapse during wars. They dip. They experience sharp volatility for several weeks, and then, across 110 years of documented history, they climb. The Dow gained 50% during World War II, 60% during the Korean War, and 27% across the Vietnam conflict. The S&P 500 has delivered positive one-year returns following 73% of all armed conflicts since 1945. The stock market has navigated 2 world wars, a nuclear standoff, a pandemic, political assassinations, and a debt ceiling crisis without a weapon being fired. Understanding why requires one insight. Wars are, from a purely economic standpoint, the most aggressive government stimulus programs in human history. When a country enters a conflict, spending becomes essentially limitless. Weapons, fuel, logistics networks, medical infrastructure, and communication systems all flow directly into publicly traded companies. The government becomes the single largest customer in the economy overnight and does not negotiate price. That money enters corporate earnings. It moves markets upward. The investors who suffered most in every major conflict of the past century were not the ones who held their positions.
They were the ones who sold their broad market exposure to reach safety and then watched the recovery from the sidelines in cash that was quietly losing purchasing power every single day they waited to feel comfortable enough to re-enter. You can understand every piece of information that follows and still make the wrong decision. The wrong decision will not feel like a mistake when you are making it. It will feel like clarity. Panic selling does not feel like fear from the inside. It feels like finally seeing through the noise. The market is declining, the headlines are alarming, the situation is genuinely uncertain, and selling feels like the rational, controlled response. You execute the trade and experience a wave of relief. You have done something. You are no longer watching passively while a number falls. And then the market recovers. Perhaps it gets worse first. Perhaps it takes 3 weeks, but it recovers because across modern financial history, it always has. And you are on the sidelines waiting for the moment that finally feels safe enough to re-enter. The answer your brain provides is always the same. Not yet. Once things stabilize, once there is more clarity. By the time clarity arrives, the snapback has already happened. JP Morgan quantified this with precision. A $10,000 investment held in the S&P 500 from 2005 through 2024 grew to $71,000 if left untouched. Miss the 10 best trading days across that stretch, and the balance drops to $32,000. Miss 30 days, and the entire 20-year period produces essentially no return. 7 of the 10 best trading days in any given period occur within 2 weeks of the 10 worst. The crash and the recovery are practically the same event. The financial media covers the crash in exhaustive detail. The recovery receives a fraction of that attention because good news does not sustain viewership. The order of these steps matters. Each one creates the foundation for the next. Capital cannot be deployed intelligently when one unexpected expense would require liquidating it. A position cannot be held through volatility when the investor is financially overextended. The structure builds from the ground up. Step 1. The cash floor. 6 to 12 months of expenses, nothing more. Before any investment is considered, the foundation is 6 months of living expenses in a high-yield savings account or government money market fund, plus $2,000 to $5,000 in physical cash kept at home. When Russia was removed from the SWIFT payment network in 2022, Russian citizens encountered non-functional ATMs, not because their money was gone, but because the digital infrastructure moving it was switched off. Cyber operations are the documented first-strike tool in modern conflict, and payment infrastructure is among the most valuable targets available. Physical cash is not extreme preparedness. It is a basic hedge against a short-term banking disruption. This is also precisely where the cash allocation ends. Wartime inflation averages 4.5% against 3% in peacetime. Every dollar beyond the emergency floor sitting in a savings account is slowly losing real value, while productive assets move upward without it. Build the floor. Stop there. Move on. Step 2. Gold. 10 to 15%. The instinct to buy gold immediately during a crisis is correct about the asset and badly mistaken about the timing. The investors who purchased gold at its January 1980 peak during the Soviet invasion of Afghanistan waited 26 years to break even in inflation-adjusted terms. Gold spikes on fear, then surrenders the premium once the worst-case scenario fails to materialize. The optimal entry point is before the crisis occupies the front page. What makes the current environment different is structural demand. Central banks began purchasing over 1,000 tons of gold annually starting in 2022, the highest levels on record. This is institutional repositioning by the people managing sovereign wealth, diversifying away from dollar-denominated assets. When that dynamic is in motion, the move carries duration that fear-driven spikes do not. IAU and SGOL both hold physical gold at near zero cost and are the most practical vehicles for this exposure. Step 3. Defense. 10 to 15%. This is the allocation wartime history presents to investors in every significant conflict, and the one most people decline because it creates discomfort. The financial media will occasionally note that defense stocks rise during conflicts. What rarely gets communicated is the scale. Raytheon gained 37% in the single week following September 11, 2001. A $10,000 investment across the top 5 defense contractors on September 18, 2001 was worth $97,000 by August 2021. In 2022, while the S&P lost 18%, defense stocks outperformed by 28 percentage points. The current environment carries a structural dimension beyond any single conflict. Defense sector backlogs would require years to clear even if every active conflict ended tomorrow. Poland is spending over 4% of GDP on defense. Germany approved a €100 billion defense fund in a single decision in 2022. European defense spending has broken records each year since. XAR is equal-weighted, meaning no single company dominates the position, and has returned over 20% annually across the past decade. Step 4. Energy, 10 to 15%. The sequence never changes. Conflict tightens supply, uncertainty generates price premiums, energy companies generate substantial cash flow. In 2022, while the S&P 500 declined 18%, XLE gained 64%. That 82-point divergence in a single calendar year is the largest gap between energy and the broad market in the ETF's recorded history. The financial media spent that year covering the technology sell-off. They simply omitted the asset class that was quietly appreciating 64% during the same period. Step 5. Consumer staples, 10 to 15%. Vacations get canceled during wartime. Restaurant visits decline. Discretionary purchases get deferred. The purchase of laundry detergent, over-the-counter medicine, and household essentials continues without interruption. When the S&P was down 17% through August 2022, XLP, holding Procter & Gamble, Costco, Coca-Cola, and Walmart, declined 4%. 13 percentage points of protection at a 9 basis point expense ratio with a 2.5% dividend yield. It does not generate excitement. It generates stability during periods when stability is the most valuable thing a portfolio can offer. Step 6. Inflation protection, 5 to 10%. During World War II, U.S. government treasury bonds lost 67% of their real value. The universally recommended safe haven was among the worst investments of the entire war. Wars require governments to borrow at enormous scale. Inflation follows, and standard treasury bonds paying fixed nominal interest get destroyed in that environment. Tips: Treasury inflation-protected securities adjust their principal automatically when inflation rises. Series I savings bonds purchased directly through treasurydirect.gov carry 0 expense ratio and full inflation adjustment. The 1-year lockup they impose functions as a behavioral guardrail preventing panic liquidation of an inflation hedge precisely when that hedge is most needed. Avoid TLT. Long-duration nominal treasuries suffer most when inflation is running and government debt issuance is expanding. Index funds, VOO, VTI, SPY. These positions are untouchable. CFA Institute analysis covering every major armed conflict in the modern era found that large-cap U.S. equities returned 11.4% annually during wartime, exceeding the 10% peacetime average. Keep automatic contributions running. A market downturn is the single best time to contribute to a Roth IRA. Tax-free growth purchased at a discount during the exact period the financial media is broadcasting maximum urgency is one of the most powerful positions available to a long-term investor. Mark sold $40,000 in index funds on February 24, 2022. The S&P 500 fell 2.5% that morning and closed the day up 1.5%. The market had already priced in the uncertainty. Mark missed the intraday recovery, sat in cash for 4 months, paid capital gain stocks on the sale, and re-entered after energy had already returned 64% and defense had already outperformed by 28 points. He captured none of the crisis upside and permanently locked in the tax liability. His $40,000 4 years later is worth approximately $48,000. Sarah kept her contributions running. She maintained her existing positions and added tactical exposure to XAR and XLE. Her original $40,000, combined with contributions made while the market was down and her tactical positions, is worth approximately $91,000. Same starting balance, same news alerts, $43,000 of difference. Sarah did not identify an extraordinary investment. She did not time a bottom or predict a specific outcome. She bought high-quality assets consistently while prices were low, held through volatility designed to trigger exactly the reaction Mark had, and avoided the single most expensive mistake available to any investor during a crisis, which is allowing fear to feel like intelligence. She bought the fear. Mark paid for it. When the moment comes, and across financial history it always comes, every headline will be read. Some commentator with complete certainty in their voice will be explaining why this particular situation is fundamentally different from every previous scenario in which the market recovered. The investor without a structure will open their brokerage app, execute a sale, experience a brief sense of control, and spend the following months watching the recovery from the sidelines while the financial media that generated the panic runs advertisements for the brokerage that processed the trade. The investor with a structure will review the positions already in place. The cash floor, the gold, the defense exposure, the energy position, the consumer staples, the inflation protection, the untouched index funds. Then they will put the phone down. One of those investors builds wealth through the crisis. The other funds the system that was designed to prevent them from doing exactly that. The time to become the second investor is not when the situation is already unfolding. The time is now, when the decision can be made with clarity rather than fear.